Dave was bemoaning the fact that there's lots of money in the city of London, but all the ideas are boring, Graham was in the fact that there's lots of great ideas in Oxford, but there's no money. The two of them got together and both and said, well, what would be the right vehicle, what would be the right structure, what would be the right team and the right business model to bring those two together and solve that problem? And that's really where IP Group came from.
How important is it, do you think, helping a startup like this bridge that gap of funding from seed and Series A all the way through?
It's critical. Most important in the early stages when the sums of money involved might not be as large. And that tends to be where the company has the most gaps, perhaps in terms of resourcing, capability. And so there's a real opportunity and often a need for investors to be able to step in, taking a new piece of technology direct from a university lab. We'd love to say, and we're generally looking to say this will get through to maturity on a 5 to 7 year timeframe. Experience and history says it takes longer, and so having the ability to be, we say, patient but not lazy with our structure has been really, really important for us to be able to do what we do over the years.
Welcome to Before It Scales, the podcast about first-of-a-kind clean energy and industrial projects, the people building them, and what it takes to get them across the line. I'm Joy, and I'm a principal at Scion Ventures. Before we begin, I'd like to acknowledge the traditional owners of the lands on which we are recording today and the traditional owners of the lands on which you are listening. We pay our respects to elders past and present and future and extend that respect to all Aboriginal and Torres Strait Islander peoples. Our guest today is Mike Molinari, Managing Director of IP Group Australia. IP Group is one of the most active early-stage deep tech investors in the country. They partner with Australia's leading research universities to find breakthrough science and turn it into companies across clean energy, life sciences, and deep tech. Mike, welcome to Before It Scales.
Thanks, Joy. Great to be with you. I should borrow that introduction. You do it better than I do.
Shall we begin with a little bit more about you? You started your career at McKinsey, you did a Doctor of Philosophy in Biomedical Engineering at Oxford, and you even had a stint at Cricket Australia. How did that path lead you to deep tech investing, and why Australia?
Yeah, great question, Joy. My own background, if you go back far enough, I grew up in a small town in country Western Australia, about 300 kilometres out of Perth. I ended up at Melbourne University studying chemical engineering. And then, as you say, I spent a couple of years at McKinsey and Company locally here in Australia before I had the opportunity to go over to the UK and do a PhD in biomedical engineering over there. And for me, I was always incredibly fascinated about the interface between really great science and how you take that out into the world and make a difference. I would say I've seen the other side of that coin without getting into too much detail. Like a lot of people doing a lab-based PhD, I realised that whilst hugely important, that's not what gets me out of bed in the morning and motivates me. And on the flip side, from the experience of McKinsey, working with some great but very large companies, for me, sort of a role, perhaps a more generic role within a large corporate, wasn't the most motivating, and I felt like it was a bit too far away from fantastic science and making a difference. And so, being able to sort of operate at the interface between that sort of great science and getting that out into the world and developing products and making a difference is what I realised through that early part of my career really makes me tick. And then I had the opportunity to join IP Group in London, coming out of PhD over there. IP Group had started back in 2000 with Oxford University and was really pioneering the model of investing in and helping to build companies out of great research at British universities. And so it was a real privilege and a real pleasure to be able to join the team over there coming out of university and having the opportunity to see pioneering finance work alongside the pioneering staff.
And IP Group describes itself as a deep tech investor. So can you explain a little bit about what that actually means in practice, and what does the IP Group model look like from the moment you spot a technology in a university lab to it becoming a company? Because it's quite a unique model.
Yeah. So deep tech first, it's a term that probably came into vogue in the last decade. So in some ways, we predate deep tech, I would say. But deep tech has really grown to cover investing in IP-rich uh, companies, IP-rich startups, with typically a reasonable amount of technology risk still attached to them. So perhaps by way of counterexample, investing in a new social media platform, or another e-commerce play where there is an element of new tech. You're often developing a new, some new aspect of the platform, but really, if you can visualize it and particularly with Claude Code and a lot of the AI tools today, you can make it. Whereas in deep tech, where we're investing in and taking on challenges, where the outcome is in some respects uncertain, with typically new science and definitely new first world technology to be developed to solve the problems that we're setting out to solve. The second part of your question was how do we work and what does the IP group model look like? So if you go perhaps right back to the origin story, which might be instructive, IP Group started back in 2000 at the University of Oxford, and it was really two people coming together. One was an Oxford history grad who was running an investment bank in London, a guy by the name of Dave Norwood, really fascinating guy, chess grandmaster. He was Demis Hassabis from DeepMind's chess mentor when Demis was in high school. Fascinating, really fascinating guy. But he got together with Graham Richards, who was the head of chemistry in Oxford at the time. And like all things, I think the story's probably grown a bit over the years. But in a nutshell, sort of Dave was bemoaning the fact that there's lots of money in the city of London, but all the ideas are boring. And Graham was in the fact that there's lots of great ideas in Oxford, but there's no money. And so the two of them got together and both sort of deep first principles thinkers got together and said, well, what would be the right vehicle? What would be the right structure? What would be the right team and the right business model to kind of bring those two together and solve that problem? And that's really where IP Group came from. So importantly, we're not a sort of traditional 10-year GPLP fund structure, if that means things to people. We are inherently evergreen. So IP Group listed on the UK stock market pretty early on. And that means that we've been able to raise money from our shareholders in the same way that any other public company does. And then, that balance sheet is what we invest from. And at least in theory, our shareholders are able to, if they want liquidity, if they want to realize their investment, they can sell their shares. If they want more exposure, they can buy some shares. And so we're not locked into that, we have to shut up shop effectively within 10 years and sell all our companies and return that cash to our underlying investors. And that's been really powerful over the years. So taking a new piece of technology direct from a university lab, we'd love to say, and we're generally looking to say this will get through to maturity on a 5 to 7 year timeframe. Experience and history says it takes longer, and so having the ability to be, we say, patient but not lazy with our structure has been really, really important for us to be able to do what we do over the years. So that's a bit of the history, and that I think informs what we do. Like that's what we were built to do. That's what we've always done. That's what we're set up to. It's baked into our DNA. The journey for a new company or a new technology with us often doesn't have to, but for completeness, let's start right at a university lab. So we're partnered with a group of 8 universities here in Australia. We also have relationships with most of the other research universities. And so if an academic invents something new and something exciting at their lab, typically this is coming out of 10, 15 years of world-leading research. We'll, through the university, generally have an initial conversation either with the commercialisation office at the university or with the researcher, and really deeply understand what is the invention, what is the technology, and really importantly, what's the differentiation? What does this enable, and what does it unlock that nobody else in the world can do? At that point, is one of the points where our global network and global scale and experience is really helpful, because we've seen nearly everything that's come out of the UK universities, the Australian universities, and a lot of the universities in the US, where we were operating for about a decade. And so we've got that really strong internal comparator set. And we tend to say to our researchers in the universities we work with, on the one hand, that's really hard because in order for us to get excited about something coming out of an Australian university, Monash or University of Sydney or UQ, we have to be convinced that it is better than anything that we've seen out of Oxford, out of Cambridge, out of Penn, out of Princeton, as well as the other Australian comparators. But on the flip side, where we do decide to engage on a new technology or a new company and invest, they can have a high degree of confidence that what they're doing really is the best in the world, because we've compared it against that sort of knowledge bank internally. So we'll spend some time. Typically, it might be 6 months, ideally shorter, but that is often how long it takes for us to work alongside the researcher, the university. Sometimes the researcher wants to be founding CEO and leave their role at the university and run a company. Often they don't, which is fine. The reality is they're a world-class researcher. We shouldn't be expecting them to be a world-class CEO as well. So we'll work alongside, assess the technology, develop a business case, develop a business plan, and get very, very close to it and deeply involved through that period. And then get to the point where we're ready to set up a company. We'll then got the ability to invest, and we can talk a little bit about sources of capital and how we invest. But that might be anywhere from say 500K to 5 million. More typically, kind of 1 to 3 million as a first check into setting up a new company, and then we'll continue to work alongside the team in a pretty hands-on fashion through the lifetime of the company.
And so does that include helping them get subsequent rounds of funding as well to sort of get through to the commercial stage?
So a great example, just to make it a bit more real perhaps for us here in Australia, might be a company called Hysata that some of the Australian audience may be familiar with. So this was a company that came out of research by Jerry Sweegers at the University of Wollongong. One of my team had a long-standing relationship with Jerry, and so when he came up with the discoveries that have gone into Hysata's technology, he called Paul from my team, and so we spent some time with Jerry understanding the technology, which is really a novel architecture and a novel design for an electrolyser for making green hydrogen that is highly efficient. So we dug into it. Today's electrolysers are roughly, and it's sort of varying and changing all the time, but incumbents, let's say 70 to 75% efficiency. So 75% of the energy that goes in gets converted into hydrogen. The technology from Jerry's lab had the promise of being greater than 95% efficient, and that makes a huge difference. Obviously, energy is one of the biggest costs. The more hydrogen you get out per unit of electricity in makes a difference. And I'll sound like a convert here, and I am. I'm on the board of the company, say that. But Alan Finkel, who chairs, former chief scientist of Australia, who chairs the advisory board, put it really well in saying you're 20% more efficient, but you're 80% less inefficient. And so running an electrolyser at scale, 25% of the input energy coming out as heat means there's a lot of cooling load required to get rid of that heat. Whereas if you're 95% efficient, you've got 80% plus less heat to get rid of, 80% less cooling load. And so that has a huge benefit as well in the complexity of the system. So we got really excited about this. We've seen a lot of electrolyser technology. Most of it has been around novel catalysts, which tend to be very hard to scale. The innovation that Hysata's come up with is largely an architecture one, so not a lot of novel material science to be done. And so we worked with Jerry and the team for about 6 months. We set up the new company, Hysata. We invested, and we'd also introduced them to Virescent Ventures, another Australian clean tech investor. And so they came in alongside us in that first seed round for the company. Then pretty quickly we went and took the company out to raise a Series A round of funding, up to a $40 million funding round, which was fairly significant for an Australian Series A. And that was ourselves alongside Virescent, alongside Vestas Ventures, the wind turbine manufacturer who we'd introduced through our network. BlueScope, I think, came into that funding round as well through our network. And then fairly shortly after that, we raised $111 million US Series B funding round, where, again, we'd worked closely alongside the company, introduced a number of the investors that came in alongside us in that funding round. And that's pretty typical of our model. We'll stay involved. We'll have the ability to invest throughout the maturity of a company, all the way up to pre-IPO, typically, and help to source talent and capital along the journey.
How important is it, do you think, helping a startup like this bridge that gap of funding from seed and Series A all the way through?
It's critical, and almost ironically is not necessarily the right word, but it's most important in the early stages when the sums of money involved might not be as large, and that tends to be where the company has the most gaps, perhaps in terms of resourcing, capability, and so there's a real opportunity and often a need for investors to be able to step in, fill gaps, whether that's filling a few gaps in the executive and the management from time to time, or filling gaps in terms of networks, introductions, connectivity, data, all of which are really critical to help companies be able to attract the capital, both locally but importantly globally, to get to scale and closer to maturity.
That seems to be a sort of a fundamental piece of the puzzle that's missing for some of these large industrial projects that we're seeing, first of a kind projects like sustainable airline fuel and others, where that first set of funding comes in, or a grant from ARENA and others, and then just nothing until unless they sort of get through somehow with sort of stakeholder investments or strategic investments. But there's not that sort of like support to help bring in and crowd in investors from globally and locally. So it's a problem that needs to be sort of addressed more systematically.
Yeah, it is, and the reason it hasn't been addressed systematically is it's really hard. It's asking investors to come in and really sort of in a lot of ways meet in the middle, from earlier stage venture investors who might more typically sort of tap out at a certain point, and asking them to be able to invest a little bit further, and a little bit later than they might typically do. And on the other side, customers, corporates, and infra and institutional investors being prepared to come a little earlier. And that's hard. People are generally managing money that they've raised from either investors or shareholders that has a mandate that they've raised it to take this sort of risk and invest in these sort of opportunities. And stepping outside of that or stretching the boundaries of that mandate can be difficult. As deep tech investors, we're really set up to understand and manage technology risk. And what we try and minimize a lot of the time is the amount of market risk that we're taking. Whereas on the other side of the great sort of first of a kind divide, you've got infrastructure investors who really are typically not prepared to take any technology risk, don't want to take any technology risk. They're prepared to take a little bit of market risk, but mostly want to take execution risk and back a management team to roll out a business model or an established technology or develop a project, and whether that's equity exposure or sort of debt exposure to these sort of projects. And so we manage that technology risk by virtue of the people that we have, the experience, and that we mentioned earlier, the 25 years of experience we have looking at these technologies and really investing where we see high levels of differentiation and global competitiveness from really before day one. And we try and minimize market risk by investing in technologies where, if they work, there will definitely be a market for them. And so the link between the two is really that point of differentiation. So if I go back to the Hysata example again, obviously getting it from Jerry's lab at the University of Wollongong to multi-gigawatt deployments globally, there are a few problems that we've got to solve along the way there. But we were able to get involved really early and get conviction really early on the technology, because that step from 75% efficiency to 95% efficiency has such a huge difference on customer economics that when we can develop the technology and launch that product, we're very, very confident that there'll be a market for it. And that's typically the way that we look at things. And back to your question about that first of a kind gap, for us, that tends to come in where often you've solved the technology problems and you've addressed a lot of that technology risk, but you haven't demonstrated it at scale. And in order to demonstrate it, you've got to build a pilot plant, you've got to build a first commercial plant, and the cost of that is significant. But you've got this definitional issue where, from our perspective, perhaps, or our company's perspective, the technology problems have been solved. From the point of view of an infrastructure or a project finance, an infrastructure investor or a project financier, they haven't seen it at scale yet, and so they're uncertain. So you just have this sort of translation gap, where it is hard, and it really requires a lot of effort and often, a shared mission between parties on both sides of that gap to really make it work.
We've just heard a lot about it being the space where returns are low and risk is high, and so nobody wants to play in that space. What do you think about the benefits of blended finance, and do you think that could play a role in this space?
Yeah, it has to, it's really the way things, that's how, for any given technology, you solve it. How you pull all the pieces together is going to be different every time. And so there's lessons definitely that we can learn. And I'd say, I'm happy to share some stories about lessons that we've learned from some of our portfolio companies here and in the UK. But the way that it's actually come together in practice in every situation has been different. And so it needs support from earlier equity investors who might need to dip a bit deeper into their pockets, to take some equity risk a bit later into these projects. it needs support from government, and that's somewhere where I think the Australian government through ARENA has been doing a really good job actually in the last 5-6 years and before, but particularly I think in the last 5 or 6 years. And it requires institutional support, whether that's from perhaps some of Australia's superannuation funds, infrastructure investors, and project financiers to be prepared to step in and take a little bit more risk. And corporates, I should say, strategic investors, who have a really important role to play. So it's that combination of earlier investors, later investors, support from government, and support from end customers that need to come together to make these projects happen. And I mean, I'll be preaching to the converted with your audience, but what I always go back to is, this number's come down in the last 4 or 5 years, but if you go back to the 2021 IEA report, something like 40. The technologies required to address about 46% of net zero didn't yet exist.
Yeah.
That number by 2024, which in 3 or 4 years is phenomenal, that's now about 35%, I think, in the latest report.
Right.
And it matters. There's an opportunity there, a great, huge financial opportunity for getting new technologies through that valley of death for first of a kind. But there's also a need, and for large institutional investors and for government, it's really important that they do step in to help to fill that gap, to meet their own commitments and create the sort of society that we can still live in 100 years' time.
Absolutely. Maybe that's a good segue to chat about the Climate Catalyst Fund, which is a $50 million fund that you launched back in March with CFC as a cornerstone investor. Could you tell us more about the thesis behind the fund and why you've launched it now?
Yep. So really excited about the Climate Catalyst Fund. As you say, we launched that alongside CFC. And the commitment from CEFC was as part of their Powering Australia Technology Fund, where as part of that, they've invested in now 3 different clean tech or climate tech early stage investors here in Australia. And it's fantastic to have the CEFC on board. They've been a transformative investor in Australian infrastructure since they were established. And with this commitment to us and to the 2 other managers, it's really good to see them stepping up the risk curve a little bit, albeit indirectly through managers, and supporting investment in technologies of the future that are developing new technologies that will, over the next decade, be the basis for investing from, I hope, investing from the CEFC core fund as they become a rollout problem rather than a technology development challenge. So the thesis with the Climate Catalyst Fund at the highest level is similar to what I've just laid out. We're focused on hard to abate sectors and developing new technologies that are going to be able to shift the needle for Australia, but also shift the needle globally in creating the technology tools that industry needs to decarbonise. So we're a deep tech investor. We're comfortable taking technology risk and focused, not exclusively, but largely focused on the hard to abate sectors. The fund was a $50 million first close. We are looking to move to a second close, targeting up to 150 million, which would be fantastic, and talking to a number of institutional investors for that at the moment. The why now is a really interesting question, and I'm glad you asked it, because I think the answer to that is a little bit counterintuitive. So what we've seen in global investment markets and deep tech markets over the last 5 years is this giant vacuum that is AI just hoovering up all available cash. And I mean, we're very conscious of it at the moment with SpaceX IPO about to start trading later this week. OpenAI have just filed for an IPO later in the year, and obviously Anthropic as well. Google have just raised 80 billion in capital markets, and we're looking at sort of primary raises for AI companies of about 500 billion in capital public capital markets. On top of that, a sort of $1 trillion rollout in data center investment. So it's been a huge focus. It's been hoovering up a lot of capital. The really interesting question is, what's next? And the lens that I actually look at this through, I've got 13-year-old twins, and what are they going to do? What are the skills that are going to be important for them in a world of AI? What do jobs markets look like? What do economies look like in 5 years and in 10 years? And the reality is they're going to be very, very different. We're going to see huge differences in the way we interact with data and online, and what has been the knowledge economy and knowledge jobs of the last 20, 30, 50 years are going to be very different. And I think what's going to be increasingly important is how we interact with the physical environment. And the first order question, what are the technologies that are going into data centers to reduce their energy load and reduce their environmental impact? And that's an obvious sort of first order impact. Great, let's invest in some HVAC technology, and we're doing that. Let's invest in some energy efficient, some technologies that help to make chips and or algorithms more efficient and reduce energy load. So we're investing in some technologies around that. How do we reduce water usage and water footprint? Looking at some technologies there. But then the second order is, what are the jobs that are going to matter, and where are the technologies that are going to be geopolitically important once AI is ubiquitous? And there it comes full circle, I think, back to a lot of clean tech and climate tech. How are we generating energy? Where is that coming from? Where are the raw materials coming from? What's the environmental impact that they're having? And really that comes back to a lot of the hard to abate sectors and a lot of the really deep fundamental technologies that we invest in and that we're looking to invest in through the Climate Catalyst. And as I say, counterintuitively, it's I think actually AI is what makes now the right time to be investing in new technologies for a future where AI is increasingly prevalent.
You said that the fund targets a 30 to 50 trillion global decarbonization opportunity, which is an enormous number. How do you think about that addressable market when you're making a seed investment in a company that might still be 3 people in a lab? How do you think about what that could look like?
That's the fun bit, Joy. Is really being able to turn your mind to what could be. We tend to look at these things, both top down and bottom up. And so, from a top down perspective, what is the global market that you're selling into, or will ultimately be selling into, and what does the growth and scale of that look like? I mean, there's obvious easy ones, novel cooling technology or semiconductor. Yep, great. AI. Data center rollout is going at a phenomenal growth rate, and it's a huge market. Those sort of things are quite easy to look at. Where it can get a bit harder is where you're looking at opportunities that rely on industries evolving in a certain direction, and that's where we'll often speak to companies in our portfolio that are operating in that sector, and we'll speak to our colleagues and advisors around the world and be able to form a view on what key industry drivers are and how markets are likely to evolve over the next decade or so. And then on the flip side, importantly, we have to look bottom up and what is the pathway from often a lab bench through to getting a first product into market, and what are the particular dynamics of that market? How do you sell? Where are the customers? How do they buy? And what are the capabilities and capital requirements that an individual company needs to have to be able to sell into that market? And so we'll look at both of those, and as always, it's about understanding the risks and what can we do to mitigate those.
And obviously you've mentioned AI already as being sort of a big topic right now. But outside of AI adjacent themes, are there any other sectors or themes that are popping up for you that are super investable that you're excited about?
Yeah, we're really excited about the opportunity for Australia in decarbonising the mineral supply chain, and that brings together legacy industry for Australia that has driven a lot of our economic growth over the last century, digging up minerals and shipping them out, and the future where that is going to continue to be important, but it's clear that we can't keep doing that in the way that we have historically. So 2 examples from our portfolio: we've invested in a company called Electrolyser, which span out from Monash University, developing a lithium selective membrane technology for extracting and refining lithium without needing additional chemicals, minimal additional water, and without requiring the huge land areas that are needed for evaporation ponds and a lot of the traditional way of extracting lithium. Similarly, we've invested in a company called Banksia Minerals Processing, which is an earlier stage company out of the University of Queensland, who are developing a more efficient way of refining copper. And there's probably some links there, to AI and the electrification of the economy, which is going to need huge amounts of copper. But their approach has the dual benefit of reducing the energy requirement of traditional copper refining, and also being able to handle a broader range of ores. And so just as a sort of slight vignette and a story on copper that I think is really interesting for something that's so important for the Australian economy and the global economy. 50 or so years ago, a globally competitive ore body in copper was 6 to 12% copper. Today, a globally competitive ore body in copper is about 1%, and that is a huge downgrade in the quality of these ore bodies, which just means that so much more ore needs to get processed and moved around in order to produce the same amount of copper. And one of the ironies is that some of the best undeveloped copper assets are now the tailings dams from the old mines. When they had 12% copper, they were pretty happy putting 2%, out the back end into their tailings dams. And now 2% makes them some of the better copper deposits in the world. So there's a lot of opportunity there for new technologies to come in, be able to extract copper with lower environmental impact, and then on the flip side, actually help with the rehabilitation of tailings and liabilities in some of these projects.
Very interesting. You mentioned a little bit about how you think about identifying some of these technologies to work on. But I'm curious about how else you do due diligence. You've talked about the market, you've talked about the science, which is obviously very important. What else do you consider, where you've got no customers, no revenue, and potentially not even a clear product yet? What else do you think about when you're diligencing one of these potential future companies?
Yeah, great question. So, I mean, we will look at, as you say, look at the technology, make sure that we've got a really strong entitlement, so improvement over technology that's out there, and that's a big enough difference to be able to survive 5 to 7 to 10 years of development and competing technology development around the world. We'll obviously look at the team. We're a bit unusual as an investor in that we're often, we are willing and often will step in and help to build a team, particularly where it's something quite raw coming out of a university. And so we've done that a number of times. We've helped to bring in a CEO and senior management to develop one of these companies. But team is really important. We'll look at capital requirements and development pathway. So there are some areas where the capital requirements are so great that it makes it very, very difficult to invest and to generate the returns that we need to as an early stage investor. So even for us, and we know we've talked about the need to fill that gap, there are some where it is very, very hard. And we'll obviously look at the nature of the industry and the scale of the returns. So what is the ultimate market we're selling into? What do the growth rates look like? And what's the business model, and what can we look at in terms of value capture around that?
And what makes you walk away? I mean, you mentioned perhaps too capital intensive, but are there any other red flags that you say you're looking at a high potential technology, but what would make you sort of step back from that?
Lots of things, and we often talk about what we do as sort of threading 4 or 5 needles at once, and so there are a lot of things that are necessary but not sufficient to make a project investable. I think one of the things that I would say to aspiring entrepreneurs out there. One of the biggest red flags for us, to be honest, is openness, or a lack of openness. And I don't love the phrase, but we talk a lot about coachability. A bit of a cliche to say that the average startup lasts longer than the average marriage. Data actually does bear out on that. And so. The relationships between an early stage investor and founders and entrepreneurs is just fundamentally important. It can't be transactional. We sign a document and we walk away. We're going to be working alongside each other for many years, and so that needs to be built on a really strong foundation of trust and shared learning along the way. And if we get a sense of that early on, that we for want of a better word, that you can really work with someone, and there's a sense of mutual respect, that's hugely important. And conversely, if there isn't a sense for that, or there's sort of a lack of transparency or openness early on, then that's very difficult to overcome.
That makes a lot of sense. With such a, as you say, patient but not lazy capital, you're in it for the long haul. It would be good to just talk a little bit about policy. So the Future Made in Australia agenda had committed 22.7 billion over 10 years to making Australia a clean energy and advanced manufacturing leader. So very much aligned with what we've been talking about today. From where you sit, backing pre-revenue companies, is that policy framework helping? Is the money getting to the right stages?
So, yes, but I think we could be doing better. So I think Future Made in Australia is fantastic. It is great to have government being prepared to invest and lean into the sector. We talked earlier about getting projects through that sort of first of a kind valley needs support from all angles, and government is a really critical party in that. And government should be playing both through grant support, and ARENA do a great job in this space through a number of their grant programs, and being more than just money in that. And a big thumbs up to ARENA there. They bring a lot of expertise, and they've got some really, really great people. So I think doing a good job on that front. There are always small areas where you'd say it would be great if there was some more capital. It'd be great if there was some greater ability to support projects that might fall just outside scope in some of their programs. But in general, I think it's great. And I think the NRF is a great start, I would say, in terms of what the government is doing in this space. If we look at all of our competitors globally, the US is probably, under the Trump administration, a little bit of an outlier in the last couple of years. But if we look at the UK, if we look at Israel, if we look at a lot of the European countries, there are really significant government programs of support for technology of national importance, and those are programs that are durable and last through electoral cycles. And so I think we're at a relatively early stage in Australia in the maturity of that support environment. And what I think is going to be really important is stability, and really what private investors and private capital needs to see is stability. Uncertainty is the enemy of that. And so, if there's some stability and certainty, across the next 5 or 10 years with the NRF funding through ARENA, that's something that private capital investors, ourselves and others, can really learn to optimize around and hopefully continue to grow this sector.
And how important is it that these companies that you're identifying and others actually stay Australian? So IP Group is obviously London listed and you operate globally, but so is there a bit of a risk that some of the best technologies get invented here but then scale somewhere else?
I think that's going to happen. So just in terms of IP Group quickly, we're UK headquartered, but we have an Australian team of 12 here. We manage just over $500 million here in Australia, and we're investing in Australian companies. None of our companies that we've founded or invested in here have gone offshore, and so we're very much about building Australian companies in Australia. But the reality is they are all selling into global markets. Their customers are going to be global. A lot of their suppliers are global. And in order to have the impact that we want them to and put a dent in the challenge of net zero, they have to be global. And so sometimes that means that the right thing to do is to do some of the manufacturing offshore, either to be closer to customers or to access specialist expertise. What we need to do, I think, here in Australia is to make sure that we are the best place for as much of the activity of these companies as possible. And in that way, we will continue to build really the virtuous circle where, one company retains some manufacturing here, which builds up some specialist expertise that then, company B can take advantage of. And then suppliers will be able to start to scale in Australia. And so that's really the sort of the ecosystem that I like to think we're doing a good amount to help to seed, and we'll hopefully be able to play a part in continuing to see that grow. And the alternative of taking too parochial an angle on it and saying, we need to retain everything here, and every time somebody manufactures anything offshore, it's a failure, runs the risk of just making our Australian companies uncompetitive globally. And then they just will not be able to scale and will ultimately end up withering away into irrelevance. So it's important to get right.
And is there anything in the ecosystem that you would add? If you could wave a magic wand and add to the ecosystem to make all of this easier for everyone, what would you add?
I'm an investor, Joy, so capital.
Capital.
But I think to perhaps take that to the next sort of level of detail, it's institutional capital. We have it's a bit of a cliche because it gets talked about a lot in the sector, but we have one of the world's largest pools of retirement funds in our superannuation industry. And on the other side, we do have globally competitive technologies and globally competitive companies that struggle to access the capital that they need. And, there are some, I guess, differences, gaps in translation between large pools of institutional capital and globally competitive companies that at the moment, the translator's not there, the plumbing isn't connected as well as it could be. And so what I'd love to see is some more openness and willingness to engage from our institutional capital allocators in how do we build these industries and deploy some of their capital in companies and opportunities that will generate them fantastic returns and improve Australia's economic situation and ultimately grow the pie for all of their underlying members and retirees.
You have first-hand experience with this, right? With the Host Plus work that you guys do. How does that model work?
So we manage just over $400 million for Host Plus, which is one of Australia's largest superannuation funds. They started with a strong heritage in the hospitality industry, and as a result, they have a really young member base relative to some of the other superannuation funds where their member base skews closer to retirement. And what Host Plus have done and talk about publicly, is to say, well, that enables them to capture more of the liquidity premium and to make investments that might have a longer time frame for generating returns. And so, they have been the largest investor in venture capital in Australia, and we've been lucky enough to be one of the managers that they support. It's a fantastic relationship, and Sam and David and the team at Host Plus, I think really deserve a pat on the back and for being prepared to have that vision, have that conviction, and then to execute and follow through on it. And I think they will be rewarded when they're seeing the rewards of that. I think they will be rewarded, and their members will be rewarded for that over the next decade or two. We'd love to see some more of their peers developing that same conviction.
That would be fantastic. Yes, there's a lot of exciting things that could be catalyzed with some of those funds. So, wouldn't that be wonderful?
But I do think, and often these discussions rely on a moral argument, sort of a normative argument. This is what in superannuation funds or institutional investors should be doing. I think it's important that the investment that is being made in the sector is commercial, and it is being done with a purely commercial rationale, because that's sustainable. We need to be delivering the returns back to Australia's superannuants that mean that it can make sense to continue allocating towards these opportunities. And so that's our challenge, and that's the sector's challenge over the next, pick your time horizon, 3, 5, 10 years. We need to show that investing in climate technology, net zero technologies, does generate competitive returns and competitive on a risk return basis, not just relying on moral argument and this is what we should be doing. I firmly believe that the case is there, and that we will demonstrate that, and there will be significant benefits for early movers. But that's where we need to get to it. It does need to be a commercially based argument, not just a morally based argument.
Yeah, I think that makes complete sense. It just has to be financially sustainable. Yeah, sustainable. We actually heard on our previous interview that there's actually no, and I think you alluded to it earlier. Outside of AI and AI adjacent industries, there's nothing else that's the next source of growth. So this is where we need to play, and where institutional capital needs to be playing to make good returns for their members. Mike, just to close off, what are you most excited about right now? You've talked a little bit about some of the sectors you're interested in, but is there anything else that you're really excited about, technology-wise or company-wise or direction or movement or trend, that's keeping you up at night in a good way?
doing what we do, you have to fundamentally be an optimist. And I find what I get the opportunity to do every day fundamentally exciting. So I get to work with companies that are developing new ways of processing lithium, or processing copper. I get to work with companies that are Hysata on the hydrogen revolution. I get to work with companies that are revolutionizing biotech, and different parts of AI. So there's probably two answers to what I'm really excited about. One is AI, and I've talked about that a bit. I mean, the obvious thing is what does it do for personal productivity and some of the capabilities, and it's almost like a computer game for it. I joke a little bit and say, Claude, for example, and OpenAI as well, is a little bit like a computer game for adults. Play with it, and it's amazing what you can achieve. That's really exciting. But from what am I really excited about? What that does for us is that next bounce of the ball. It's I think what we'll see is sort of the next wave being physical environment. How do we produce our energy? How do we produce our raw materials? How do we reduce our environmental impact? And that will be enabled by AI, and it's that will really define the jobs, productivity, and kind of creativity for my children's generation and the next generation after that. So I think we're at a really, really exciting time generally, but it's sort of what comes next after the near-term AI that I think is fascinating.
I like that view a lot, Mike. That's it's nice to hear an optimistic view. I have a 4-year-old, so of course I'm thinking ahead as well, and I'm really happy to hear you frame it like that. Mike, thank you so much for joining us on this episode. It's really great to learn more about the IP group and what you and your team are doing to really help catalyze these very important sectors of the future. So thank you for being here.
Thanks, Joy.
That's it for this episode of Before It Scales. If you enjoyed it, subscribe on Apple Podcasts, Spotify, or wherever you listen. And sign up to our newsletter at cyanventures.com.au for episode clips and show notes. We'll see you soon. Before It Scales.